IRS audits the Augusta 14-day rental rule and IRS wins. They shoot and they score. And you know what? If you are using an Augusta tax rule in your business, you might have a problem with the IRS. Now, today in this video, we're gonna talk about exactly what was IRS auditing, why did this business lose to the IRS by renting out their their home for 14 days under Augusta rule. And actually, to be honest with you, I kind of love this court case that just came out because it teaches us and tells us everything that IRS is looking for when a business owner wants to use the Augusta rule. And in this video, we're gonna break everything down into pieces, and you, the business owner, will now sleep better at night knowing how to actually use the Augusta 14-day rule in your business. Ready? Let's go. Hey, welcome to my whiteboard tax strategy. My name is Boris Musheyev. I'm a CPA and a certified tax strategist. Every Tuesday, I release a tax strategy video here on YouTube for you, the business owner. By watching this video, my goal is for you to start paying less in taxes right away. So go ahead, subscribe to my channel, like it, share it, and even comment below. I appreciate you. Now let's get started. All right, let's talk about the Augusta rule. Now, I've actually broken down to you into 3 simple steps. As always, we're going to talk about what is the Augusta rule for those of you that don't know. And if you're a business owner, you must watch this. We're going to talk about the facts, okay, of Synopoly versus Commissioner. That's the court case that we had that recently came out and that actually talks about what the hell did they do wrong with using the Augusta rule? How in the world were they able to do $290,000 in Augusta reimbursement? And then we're going to talk about tax court's decision. Now, this right here, ladies and gentlemen, not only is it a good tax court decision, but it's also good for us to follow as a rule, to take it, basically use it as a strategy, right? In this court decision, IRS basically gave us a tax strategy to follow. That's why I love this court case. Now, let's talk about what is an Augusta rule. Now, Augusta rule is basically a rule in our IRS tax code that says that anybody in America can rent their home up to 14 days tax-free. That means if you've got a big home and let's say, for example, you've got an extra room in your home or like, I don't know, in a backyard, like an extra dwelling unit, and you rent it out, short-term rental, whatever that may be, and the rental is under 14 days during the year, IRS says, don't worry about it. You do not have to pay any income tax on it. Now, the rule really came about because of a town in Augusta, Georgia, right, where the golf tournament takes place. And what happens is that a lot of people used to come there and there was not enough places to stay. So they start renting out places in people's homes. And then people had to pay taxes on the amount of money that people were paying them to stay there. So they came up with this rule, said, you know what? If somebody's renting a home from you up to 14 days, you do not have to pay any income tax on it. And that's it. That has been a law. That is in the IRS tax code. And that is what that is. Now, what happened is that when you do receive that income up to 14 days, it's totally tax-free. You still have to report it on what's called a Schedule E. A Schedule E is where you report all of your rental income and expenses, okay? Now, what happens is that you report that income and then you take a deduction for the same amount, okay? And you're saying, hey, I'm taking an Augusta rule deduction, so I don't pay any income tax on it. That's in a plain language so that you can understand what that is, and that's it. You do not pay any income taxes on it. Now, recently, a lot of business owners have been seeing this as an opportunity, and a lot of tax advisors have seen this an opportunity to advise their clients. They're saying, hey, by the way, if you own a business, you can actually rent your home to your business and get a tax-free rental. Your business gets a deduction and you don't pay any income tax on it. Now, is this really legitimate? The answer is absolutely, but you've got to do it the right way. And that's why we have a tax court decision to talk about that. Now, you have probably seen a lot of videos on YouTube, on Instagram, on TikTok promoting this without proper guidance to business owners. And that, I believe, exactly what happened in this tax court case over here, Synopoly versus Commissioner. And we're going to talk about it right after this break. Hey, Boris Musheyev here. Sorry for the quick interruption. 5 seconds, I promise. I want to make sure you get your free PDF, 7 write-offs every S corporation business owner must know. The link to this free PDF is in the description below. That's it. Thank you so much. Continue watching. Awesome. Let's talk about this this court case, right? So the facts are it's Synopoly versus Commissioner. I hope I'm pronouncing that right. Now, Synopoly is a business owner along with other 2 partners of a company called Planet. And it was set up as an S corporation. It had 3 owners, probably still has 3 owners, okay? And they were audited for the years of 2015 and 2017. Now, I want to make a very important point. A lot of business owners think, and I've come across a lot of business owners with which I chose not to work with, they think that it's okay to do something wrong on their taxes because IRS doesn't audit them because 1 year has passed. Hey, nothing happened. Let's do it again. Now, you are completely wrong if you're that business owner, because what happens is that IRS does audit. It just takes a little bit of time, right? They're not going to audit you, for example, for last year necessarily, but they might audit you for 3 years ago. And that's exactly what happened with these folks, right? They got audited for years of 2015 to 2017. So it's not like the year passed and if IRS didn't audit you, then that's okay. No, you always have to do things the right way in your business. You cannot cheat on taxes, okay? No cheating on taxes. Just because thinking, well, last year was totally okay. If you cheated last year and thought nothing happened, just wait for it, okay? Not trying to scare you, but I'm just kind of sharing with you the things that I've run into with other business owners. Now, over here, we had 3 owners, okay? They were using the Augusta rule. They were holding the business meetings. Now, the backstory behind them is that they were in different locations. It was very hard for them to always meet. 2 owners would come, another owner would not come. Or the other 2 partners could show up, another partner could not show up. So they needed them business meetings. So they decided, hey, I honestly don't know how they came up with this. Probably they saw a reel somewhere, right? Like, hey, why don't we meet in each other's home and we reimburse ourselves? Now, initially, Dr. Synopoly made us research and found out that square footage, a cost per square footage is $1.83. And they're like, you know what? We can now reimburse ourselves $1.83 for using our home. And that was totally okay, but they only did it for a little bit. And then very quickly, they started just reimbursing each owner $3,000 to himself using the Augusta rule. 3 owners, $3,000 per month. There was no substantiation, no competitive rates. Now, if you're a business owner that wants to use the Augusta rule, IRS says, listen, and we're going to talk about that, right? IRS says, listen, you've got to first find out how much are you going to reimburse yourself. You got to get competitive rates. These guys didn't do that. And they reimbursed themselves a total of $290,000, okay? Using the Augusta rule, $290,000. Now you might say, well, Boris, what if it is legitimate? What if they did meet and it really is $3,000 because they have a big home? Well, guess what? We're going to talk about that exactly in a tax course decision right after this break. Hey, thank you so much for watching the video. Very quickly, if you don't mind, I want to ask for your help. I need your help. I want other business owners just like you that will benefit from a video like this to catch this video. The best thing that you can do for me, please either like the video or even say something in the comments, because that really helps the YouTube algorithm when it sees a lot of engagement to push the video to other business owners just like yourself, or better yet, subscribe to the channel would be much appreciated. Thank you again. Now let's get back to the tax strategy. Awesome. So let's talk about the tax course decision. By the way, the revenue agent that was auditing this tax return 2015 to 2017 for Synopoly, his name was Jacob Burgess. Okay. Now the tax course decision was as follows. They looked at the section code 162A of the IRS, and the section code says, in order for you to take any business expense, it has to be ordinary and necessary. Was it ordinary and necessary in this case? In Synopoly's case, between him and 2 other partners, to be able to meet and to conduct business? The answer came out to be yes, because they really needed to meet and do business, right? They couldn't always work out a time and a schedule where to meet, so they've decided to meet at each other's home and use the Augusta rule. Then the IRS moved on and said, okay, in order for it to be ordinary and necessary, it also has to be reasonable in nature. Reimbursing yourself $3,000 for a use of your home per each meeting, is that really reasonable? So our revenue agent, Jacob Burgers, decided to take it a step farther. And he said, you know what? Why don't I do a research in the area and find out what is really the square footage cost, or a venue, if you are to rent out a conference room, okay, to rent out a conference room, how much would that cost? Because these guys have been reimbursing them $3,000 a month. What Jacob Burgers also took into account, he found out how many people attended the meeting. And they said, well, it's only been owners. Occasionally, there may be some other people, occasionally, and occasionally there were other family members in the house while the meeting was taking place. So he's like, oh, okay, so it's not like the home was used exclusively for the meeting. So he did some research and he came out actually with numbers way below $500 per meeting. So they said, okay, the amount that you've been reimbursing yourself, $3,000, that's already unreasonable, okay? Then, now that we have determined that it may be ordinary and necessary business expense, IRS moved on to find evidence. Did you really meet, okay? And apparently, based on the notes that I've read, their stories were all over the place, right? They couldn't really come up with the credible evidence that they met. And they also could not substantiate to the revenue agent as of what business meetings were really discussed, right? What was really discussed about the business. So this, when I look at it, I see an opportunity for a tax strategy to be used right. So what I learned from this, all right, I can use an Augusta rule as long as it's ordinary and necessary. I can use the Augusta rule as long as my reimbursements are reasonable. That means I have to look around in my area and find out how much would something for my home, go for. If it's $500 for a home like mine and I use it for Augusta meetings with my business partners, employees, company, business development, whatever that may be, then that's perfect. And then I need credible evidence, okay? And that is exactly actually what we do for our clients. We have them sign in. Who is attending the meeting? What was discussed? What was the outcome of that meeting, okay? What business was conducted? And that's exactly what IRS is looking for. So they could not find any evidence. They couldn't understand what business was conducted. The only evidence they could find, I think it was from one of the partners. For 2016, they had notes on 12 of those meetings. So they were able to, the IRS let them take a $6,000 Augusta rule reimbursement only for 2016. And for 2017, they were barely able to substantiate 9 meetings at $500, which is $4,500. 2015, the revenue agent, Jacob Burgers, just crossed it off the list. Like, we're not letting you take that deduction. So it went down from $290,000 to $10,500. Now, ladies and gentlemen, if you are using an Augusta rule in your business, it's totally okay. But you have to understand that IRS wants to make sure that you're following the section 162A of it being ordinary and necessary for your business, and the cost of reimbursements has to be reasonable in nature. You can't make things up. IRS is looking for credible evidence. IRS is looking to know what business was conducted. This is a perfect court case. Synopoly versus Commissioner. It is a perfect court case that kind of outlines for us how to use this tax strategy. Your tax preparer, your tax guy, even probably your tax planner that just delivered you a tax plan for one-time, kind of a one-time thing, did not explain these things to you. I'm here to tell you, to urge you, to explain to you, to ask you, please follow the IRS rules and regulations, and IRS will allow you and even actually applaud you for taking these deductions, using these tax strategies, as long as you're following the law. Thank you, and until the next time.